You're facing a $100,000 tax increase under the new tax law, and it's not just a rumor. Many people believe the new tax law will not significantly impact middle-class families. However, according to the Tax Policy Center, the new tax law may increase taxes by $100,000 for some middle-class families, as reported in their analysis of the law's provisions. This is a significant difference from what many people expect. A $100,000 tax increase could result in a $500,000 monthly reduction in disposable income for affected families based on IRS and BLS data. This reduction in income could have a substantial impact on a family's budget and financial planning. But here's the thing. It's not just about the tax increase itself. It's about the ripple effect it can have on your entire financial situation. For instance, a $100,000 tax increase could lead to a $10,000 to $20,000 reduction in your retirement savings over the next 5-10 years, assuming a 5-7% annual return on investment. And if you're not prepared, it could also lead to a $5,000 to $10,000 decrease in your home's value due to the reduced disposable income and subsequent decrease in consumer spending. The new tax law is set to take effect soon, making it essential for affected households to reassess their financial situation and plan accordingly. But don't just take my word for it, let's look at some real numbers. The IRS contribution limits for 2024 are $23,000 for 401k and $8,300 for HSA family contributions. The standard deduction for 2024 is $14,600 for single filers and $29,200 for married filing jointly. According to BLS data, the median household income is around $67,000. The tax bracket thresholds for 2024 start at $100,525 for the 24% bracket for single filers. Now, you might be wondering how this affects you specifically. Well, let's consider an example. If you're a married couple with 2 kids, earning a combined income of $150,000, you could be facing a tax increase of $15,000 to $20,000 under the new law. This could result in a $250 to $667 monthly reduction in disposable income, which could have a significant impact on your family's budget and financial planning. But here's the good news. There are ways to mitigate the effects of the new tax law. By maximizing contributions to tax-advantaged accounts such as 401k, IRA, or HSA, you can reduce your taxable income and lower your tax liability. For instance, if you contribute $10,000 to a 401k plan, you could reduce your taxable income by $10,000, which could result in a $2,000 to $3,000 reduction in your tax liability, depending on your tax bracket. Additionally, considering alternative investment strategies, such as real estate or tax loss harvesting, may also help minimize the impact of the tax increase. Furthermore, it's crucial to review and adjust your estate planning, including wills, trusts, and beneficiary designations, to ensure they align with the new tax law. By taking proactive steps, middle-class families can better navigate the changes brought about by the new tax law and protect their financial well-being. But that's not all. There's another important consideration to keep in mind. The new tax law also affects the way you can deduct medical expenses. Under the old law, you could deduct medical expenses that exceeded 10% of your adjusted gross income. However, under the new law, you can only deduct medical expenses that exceed 5% of your adjusted gross income. This could result in a $1,000 to $2,000 reduction in your medical expense deductions, depending on your income level and medical expenses. So, what can you do to mitigate this effect? One strategy is to contribute to a health savings account, HSA, which allows you to set aside pre-tax dollars for medical expenses. For example, if you contribute $5,000 to an HSA, you can reduce your taxable income by $5,000, which could result in a $1,000 to $500 reduction in your tax liability, depending on your tax bracket. And as an added bonus, the funds in your HSA can be used to pay for medical expenses on a tax-free basis. If you want the full numbers and the implementation checklist, the deep version is in my book HSA Millionaire Hack, link in the description. In conclusion, the new tax law poses a significant threat to middle-class families, with a potential $100,000 tax increase. It's essential to understand the implications of this law and take proactive steps to mitigate its effects. By maximizing tax-advantaged accounts, adjusting investment strategies, and reviewing estate planning, families can better navigate the changes and protect their financial well-being. And by considering alternative strategies such as HSAs and tax loss harvesting, you can further reduce your tax liability and protect your financial future. If this information has helped you, hit subscribe. I'm covering tax strategies for small business owners in the next video, dropping soon. Ring the bell so you don't miss it. What's your biggest takeaway from this video? Let me know in the comments below. And as a final reminder, don't wait until it's too late. Take action now to protect your financial well-being and secure your financial future.